Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new horse host. We're sick today. My name's Weston Walker. We interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Katie Kim. She is a mom and real estate entrepreneur. She's developed several projects in Illinois, and glad to have her on the show.
Thank you. It's an honor to be here. Love it.
Of course. Yeah, so Katie, tell us a little bit about your backstory and what you've accomplished in the real estate space.
Yeah, so I grew up in a construction development family. So actually, we're a third generation developer, real estate developer, and grew up in the family business. And my parents don't like me to say it, but I was like a victim of child labor law. I'd go to like soccer practice and then go like build walls or go to volleyball practice and shingle a roof. And it's just kind of how life was, right? I mean, it's what your norm is. And I loved it because we got to go into like the fix and flip, right? Like that was my everyday life. Growing up, we'd buy houses and turn them around. And then my parents would do a lot of development on the construction side and a lot of design build. So it was really from a young age where I sat in those rooms and listened to their clients say like, this is what we need. This is what we can afford. How do we like make it all work? And I would see my mom and my dad like put together those solutions for them, and then and then build them, right? So I got to see it all come to life. So from that initial meeting through. And then like any kid of a third generation family owned business, I went away to college and thought I'm never moving back home. I'm never buying the family business. And I got a master's degree in computer science and went to work for a tech company. And I loved what I did with them. I would work, with technology 3 to 5 years to market and find strategic profitable solutions. It's as fast as I can tell you without putting you to sleep. But I loved it. I loved going in and solving problems. And then my career took me to a startup. And then that startup got bought out by a big company, and was kind of like, what do I want to do? And my parents were like, do you want to come back and run the family company? And I said, no, not at all. But I was constantly investing in real estate on the side ever since I graduated from college. And so I'd buy another property every single year. And the development side really intrigued me. So we made a deal and I came home. I ran the construction company for about 10, 12 years, and then really found a passion and a fulfillment in the development side. And we would have a lot of small businesses come to us, like similar to what I said, the small meetings I sat in was they wanted to grow their business this way. They wanted to own the real estate versus renting, but they only had enough money to either like scale their operations or to buy a building. And so we would put together solutions where we would do, design, build, lease with an option to buy, and all those different unique ways to like get the business in the building while we owned it and then eventually transition it to them. And I found that like I wanted to take it a step further and really put more into, leaning into these businesses and figuring out how they can structure them, bring in investors in a very strategic way, as well as include those economic incentives. And so that's where I stepped out, launched the Kim Group back in 2015. And that's really our focus is a developer for fee model. And then recently we launched our online course to teach people how to do developments themselves.
Got it. So you started with your own money. You bought one deal a year, and then you scaled into development. So tell us about your early projects, how you built your track record, how you find investors, etc.
Yeah. So actually, my first real estate purchase that I ever did actually was didn't have any of my money in it. I was basically a conduit, and then like the second one I did, I leveraged my inheritance in there, and then basically the third one I leveraged the equity in the first one, and and just kind of kept leveraging the equity. And I thought like I want to get my real estate license and learn more about this. And so I did. And then I started using my commissions in my deals and then started syndicating, right? And learning how to bring investors into the deal, where I started, I think like most of us start with family and friends, to come in. And then as we were starting to do projects for other people, developer for fee, we were coaching them on how to bring investors into the deals as well. And so they would go out and make that first pitch, like, hey, I got this project I want to do. And then when they started talking about all the details, they'd be like, okay, let's go meet with Katie. And so we'd walk them through the project. We'd walk them through our pitch deck. We'd walk them through the PPM, and which we had set up for them, with their input and their decisions, but we would just guide them through the process. And then really, we really expanded that with our network, and then started to really actively look at people that wanted to invest in more deals, but just didn't know how to put them together, or didn't really want to do anything. I say that, like, actively do anything. They don't want to actively go get tenants or, property manage, or didn't want to have an active role. They wanted to really be a passive investor in the project. And so what we would do is bring them along with the experience. So we would host hard hat happy hours, where we would take our investors through the construction sites and jobs, and really bring them into that experience and teach them along the way. And the fact that, they don't get that with a lot of other investment groups or syndicators, is where, like, we're also teaching them, like, what to look out for in other pitch decks, right? What to look out for, make sure people have a proper risk mitigation strategy. What is it? What are the questions you should ask? And then also, when things don't go exactly as you plan, like, how did we get off course? What are we doing? How are we mitigating that risk? And how are we coming out of it? So for example, like COVID, we were right in the middle of two construction projects when that hit. So that was very interesting, but we had to pivot and shift. And so we, communicated with them the whole time, like, hey guys, this is what we're doing for our tenants and our spaces. This is potential tenants coming in. And we actually let them leverage a lot of our IP and the different leads and stuff we were doing and strategies for their other properties and their other investments. So we like to say that we want to teach them how to run with us. So, like, we can walk on this deal and then run on the next. And it also makes them a better, more informed investor when they come into the deals.
Got it. So you basically bring in wealthy people to your events that want to learn development. You put on these events for people, and you get through, teaching them how to evaluate, your deal, other people's deals. Is that the main way you find investors, and then they tell their friends about your events?
Yeah, we do that, and a lot of it's referrals. I mean, that's where our network is. We don't how we go into our syndications underneath the different SEC regs is we don't publicly advertise, and that's very intentional. We may shift that in the future, but right now we want to know the people that are investing with us. We want to know what they want. For example, we had one project that we did. It didn't have a lot of cash on cash return for the deal itself, but what we were able to do, because we knew what our investors were looking for, is we were able to give them double the depreciation allocation for their share of ownership. So we were able to give them more of in essence, a write-off versus a cash on cash, where if we didn't know what our investors were looking, we may not have thought how to do that. We might not have thought to structure it that way. And then it's not so much just the accredited investors or, as you said, wealthy investors. We also, because of the way we go into our syndications with having a relationship, not advertising, we're able to bring, what we would term from an SEC standpoint as a sophisticated investor into the deal, where we may have an accredited investor that says, hey, I want to get my son in on the deal. Okay, well, we may have a 10,000, a 25 or 50K gap that we're looking to fill that they can come in on. And we've done that before for, starting investors, where it's, the lowest we've done is 10. And, we wouldn't have done that just for anybody. It would have to be somebody we have a relationship with. As you can imagine, the paperwork is quite intense for all of it. But it's great to see and be able to get young investors into a deal where, at that point in time had no loan liability. There was, no kind of a risk of losing more than your initial 10K coming in. So that's where both the parent and the child evaluated the risk, and he went in and went into the deal, and then has since invested in other deals with us and with other people. So,
what kind of returns do you guys target, and over what time frame?
Yeah, so really, because we work with a lot of small businesses, we really look at what are we giving our investors that they want at the time. So, our best investment was a 353% return over 4 years. But in that time frame, our investors didn't receive anything during each year because it was a development deal. So it was all on the back end. I mean, they received some of it up front with like tax credits and depreciation and stuff, but the full realization of that 353 was over 4 years. And then we have a couple deals that have come out where, it's 75% return. So they get their initial cash plus the 75% payout. There's a couple where it's break even that have been, some of those were the COVID babies that we were good just to break out even. And then some of them are more of a long-term play where it is over time. And so it's still being transitioned out. So we don't say we're looking at this. I mean, we go in depending on which project it is with specific metrics, but it really looks at like, what do our investors look at? Because a lot of them said, hey, Katie, we want to make a good return, but we also got to figure out how we're not getting killed with taxes. And so hence the double depreciation allocation was one way we looked at that and said, hey, we could do this. And that's a great offering.
Where do you see your development business going in the future?
Where I see a development business going is, you're doing great, Weston.
We're working through it.
Yeah, I was talking to Wesley before. I said, I just came from a 4 or 5 game hockey tournament, so my voice is a little hoarse as well. Where I see us going is especially now launching the education platform, the Real Estate Development Academy, to teach people how to do their own real estate developments, and to really, we do a coaching and a community combination. So they get one-on-one with me, they get different calls, we bring in different investors and developers to question them and learn their strategies. I see that being a great way to bridge to people that they don't know the whole process, or they don't know what they don't know, and they don't want to have the risk of it. So by allowing us to really coach them through the project and coach them through their project and what they want to do, that allows us to extend our reach. And I see that as really taking off, because what we're looking at in our community, right, is you have the boomers and everybody's talking about the wealth transition and succession planning, and you have so many businesses that don't have a succession plan. I've heard a statistic anywhere between like 70 to 83% of businesses right now don't have a succession plan. I want to try and find a real statistic that I can quote on that. But when you look at how that's going to transfer, similar to like the Trefsker's Bakery project we did in Peoria, is you want to look at the whole point of view of the company and the business, or the family or the ownership of the real estate owner as the business and their succession planning. And that's where I think real estate and learning how to set up the development can make a huge impact as we're stepping into that era. We're in it right now, but how do you structure even a succession planning or a business sale with real estate or without it, and leverage both of it into that negotiation? So I can sell the business to you at one price or one way, and then I can keep the real estate, or I can sell the real estate, contract for deed with these terms. And now you have kind of created your pension plan with your real estate holdings, and then it allows the business to be sold in a very stabilized way and get ramped up. And then they could step in and own the real estate. So I think you're going to see a lot of that coming in. I hope you do, because that's really, I think, where that transition of wealth can be just a game changer for small businesses selling and succession planning, as well as not losing that wealth that owner or the family has built up, because that just buying out a lot of times, as we heard from if you've read What Would the Rockefellers Do, if you don't set it up properly, you're going to lose by a generation or two, you're going to lose all that wealth. So you really want to start teaching that next generation how to do it.
Totally. Yeah, and it's great that you're also bringing in younger investors like myself. I'm 20 years old, still in college, and want to get a piece of these projects, learn from people like
Yep.
yourself. So, what are your expectations for, your developments in the upcoming years, return projections for investors?
Yeah, so right now we have a couple of projects going on in the Texas Triangle down here, and then we have a couple P3 partnerships back in Illinois that we're going. So P3 is a public-private partnership, and those returns, I mean, I think you're going to see, at least your 10% cash on cash return. You're going to see a bigger kick on the outside, especially when you're looking at areas like Illinois, where your cash flow is very solid and stable. Like a lot of times we have East Coast, West Coast investors come into the Peoria area because one, they can get into the market at a lower rate, a lower price, and then get a consistent return. Whereas it's a higher price on the coast, and they may not get that incremental growth in the rents, as you'll see. The Texas Triangle is exploding with growth. That is going to be substantially higher. Anytime we try and put a projection on something we've done down here, it gets blown out of the water in a good way. So I think with our new administration coming in and the incentives and the tax credits that they're doing for research and development, I think you're going to see a explosion of growth in that Texas Triangle. And I think one of the things that would be interesting, I just heard this in the Hayes and Caldwell EDC meeting last week, where each state has a research and development tax credit that they offer companies. So Texas right now is 5%. California is 15%, which explains for why you have a lot of Silicon Valley and companies that are doing R&D there. Well, China, guess what China's tax credit is to their R&D businesses?
How much?
200%.
200.
200%. And
So why would they have a 200% tax credit?
that's where I was blown away. So I'm on a search to find more about that. But if you think about that, then the government's basically paying these companies to come here, right, or to their country and do research and innovation and development. And I think that's some of the motivation. What they were saying at the EDC meeting, some of the motivation with the new administration is we want to keep those jobs here. We want to bring those jobs here. So that also entails infrastructure, buildings, all those jobs that go along with it. And so I think you're going to see states start to pay attention to the R&D tax credit coming into this new administration, along with everything else that's going to be coming. So we have a family wealth and health building meeting with my kids every single week. And, one of the conversations we had last week was, okay, now you have a new administration. Like, what do you think? How do you think the game's going to be played now? And it's like, whatever you voted, this is who you have for the next 4 years. Follow the money. What's the game? What are the rules now? Because everything's going to shift. And then that's really what we want to get them in those meetings to do is look at the opportunity. There's always opportunity with each administration shift. There's always opportunity in every environment. So where is it and what is it and how do you work with it? And so I think that's going to also gauge returns, like what you're saying.
Yeah, and it's evaluating the market, the government, etc. What do you think is your biggest issue or bottleneck in your business? Is it finding investors or finding development deals to work on?
I think there's always enough development deals. It's then if people are realistic, not greedy, and if we can get the numbers to work. Investors in some of the small to mid-sized projects are harder to find. So we're constantly looking to increase our network. We're constantly looking to, learn more about what investors are looking for in our community. And within each community, we try and go and get our initial investors from that community because they have more buy-in to those projects. So it's really teaching them like what we stand for, how we set up our developments, how we, interact with our investors and move forward that way. As we look to expand more. We have some investors that are saying, "Hey, I'll go. I'll definitely invest in your projects in Texas. I'll definitely invest in your projects in Illinois or the East Coast." And so we're seeing more of the investors want to expand outside their local area, which is good. But I would say one of our biggest bottlenecks is really teaching people how to invest. The development projects themselves, there's always good opportunities if you're looking in the right areas and working with the right people.
Sure. Yeah. And how do you reduce the risk in your development deals?
So we reduce the risk by doing a good amount of due diligence up front, and then we try and go in with at least, 50% of the building either leased or committed to verbally, and or have a path to get there pretty quick. So we're looking at like having a tenant be able to at least cover the base expenses that we know we're going to have right out of the gate. We also look at having economic incentives come into play. So if they're going in an area where you're not going to have, a 20-person wait list for your spaces, you're going into maybe a mid-size or like a tertiary community. We want to put those economic incentives to help those small business owners and help the small business developers be able to stabilize the project financially. And those are opportunities that we look for in communities that we go into, is like, how much are you going to support this business financially? Not just, hey, we'll promote it or we'll, give you some press and stuff like that. It's, are you going to put your money where your mouth is? Like, if you really want this type of business or this development, are you going to give us a TIF district? Are you going to give us a business development district, SSAs, those kind of incentives? And those really help mitigate the risk in some of those deals, because now you don't have the full debt load on the project. So like the bakery project, the bakery expanded into 3 times their space, but really they expanded into 6 times because there's other parts of the building that we leased out. But even with the bakery operations expanding to 3 times, they only did it for 1.5 times their cost. And so then their operating costs, we actually halved it because we used a lot of green infrastructure and some thermo. So those are ways where you got to look at like making it financially viable, because when you see the different trends that's going on with the marketplace of in the commercial side of consumer spending and experiences versus services, our commercial space is going to change. Multifamily has been hot for a couple of years. It's cooled off a little bit. I think you're going to see that start to come back up because we definitely have a housing need. And so what's that housing need going to look like? Are you going to have services? Is it going to be mixed use? And looking at all those different opportunities, and the communities that want to brand themselves for certain generations are going to incentivize you differently. If they want more boomers, if they have boomers and they want more young people, like they're going to incentivize different developments to make sure that they're getting what they need in their community.
Yeah. And then what about the ways you increase the returns?
Sorry, say that again.
Sorry. What are the ways you you increase the return? Increase the projected returns for investors compared to other developers.
Yeah, I mean, one of the ways that we increase, my secret sauce and passion is always the economic incentives. How can we bring those into the game and make them game changers, right? And we have a good amount of contingency when we go into our projects and really bring a team. So a lot of times we'll do integrated project delivery. So the whole team on the construction side is at the plate from the beginning. So they're going to be able to help us see issues and stuff that we don't know about. If it's a new construction or rehab, if it's just an acquisition of like existing and then you're trying to, value add, increase rents, that goes into a different strategy. But looking at how do you bring in those incentives, and then how can you structure the project to really get to that next level? Because if you get the project to the point where everybody wants to be in your development and now you have a wait list, that can start to play with that supply demand equation and getting more people in.
Sure. Yeah, it's like a scarcity concept with Rolex. They do this as well. Other luxury brands, and they have a wait list of people that want the watches. So that's a very good strategy.
Especially the Snoopy watches.
Yeah. Yeah. If any investors or people that want to collaborate with you, Katie, on developments or other projects, how can they reach out to you?
Yeah, they can reach out to me at katiekim.com. That's KATIEKIM.com, or thekimgroup.com. Either way, they can find us on there and really figure out, like, they can set up a strategic call with us and figure out how they want to step in and what issues or what fear or problem they're having that they can't overcome, and we can work with them and say, hey, we can help you in this way, or connect you with somebody that can get you on the path to getting the project going.
Awesome. Well, thank you for coming on, Katie.
Yeah, thank you.